want an exposure to a market or an
Everything they need in one place.
Being the world's foremost authority on individuals, advisors and institutions.
Hello and welcome to the Morningstar series, Ask the Expert. I'm Emma Wall and here with me today is Morningstar analyst Szymon Idzikowski. Hello Szymon.
Hi Emma.
So we're here today to talk about discounts on investment trusts. Unlike unit trusts, which can issue more units with demand, investment trusts, depending on demand, either trade at a discount or a premium. Discount isn't always necessarily the entrance point, though, for investing. There are other things that should be considered, aren't there?
Yep, it's probably sort of a double-edged sword. In one way, people could argue discounts and premium adds volatility. On another hand, they can create opportunities. But as you've pointed out, we would never encourage people to buy funds only because they trade at a discount. There should be some merits behind that. So maybe one way to look at this is to look at our medalists that would indicate high quality companies and then maybe use discount as a way to time your buy decision.
So making sure you're buying quality at the right price then?
Correct.
Well, have you got one of these examples then for us, an investment trust that Morningstar analysts rate highly but is also at a discount at the moment?
Sure. Well, if we think about opportunities and maybe a little bit contrarian investing, I couldn't avoid talking about emerging markets. They still trade at wide discounts. However, the fortune seems to be turning back. So emerging markets bounced back this year. MSCI emerging market is actually marginally ahead of S&P 500. It's marginally ahead of FTSE All Share. They're getting more traction, but it's still not reflected in discounts. You can still find good opportunities trading below the long-term average discounts. And I think JP Morgan emerging market is such an example. It's a fund we actually rate bronze. It's run by an experienced fund manager, Austin Forey. He's been in charge of these funds for over a decade. He's been actually with JP Morgan for well over 2 decades. And he's got a great support from well-resourced team. And we believe he really used those resources to great extent. So actually, if you look at the track record of the fund, over the tenure of Austin Forey, it returned over 8 percentage points annualized, which is more than 3 percentage points more than its peers. But then actually last year it's been a bit tricky for the fund. So in 2013, the fund was, it didn't hold internet stocks. It was actually overweight Brazil, South Africa, India, which held the fund back a little bit. But that's probably create some opportunities to people that would like to buy it with long-term view.
And it's all about there, as you say, being brave as an investor and taking contrarian view and taking a long-term view. Just because someone underperforms one year, as you say, they're the track record, 8% annualized, one bad year is not so bad. Have you got a second example then for us?
Well, second example might be even a little bit more extreme, speaking of one single bad years. So British Empire Securities is a global equity fund. It's a sort of like a deep value investment. And last year was actually quite bad if you compare to category peers. So the fund returned about 8% points, which is probably 15 percentage points less than its category peers. But as you said, 1 year doesn't dent our view. What happened last year is the fund didn't hold Japan and didn't hold US equity, which were two of the best performing markets.
Yeah.
It held too much cash for too long in rising markets, and it had a couple of gold mining companies which performed very bad. But as I say, this is sort of like a deep value investment. It invests in out-of-favor companies that are either misunderstood or under-researched, and the team is trying to find the hidden value. So by nature, actually, they don't invest in the US because it is considered to be one of the most efficient markets. In Japan, they just didn't see catalyst at that time, and they tend to hold cash on the balance sheet as a sort of contrarian investors. So as I said, 1 year doesn't dent our view. We like they actually stick to their expertise, and they have proven they can add value over a long time.
One perhaps, though, for a satellite position in your portfolio rather than a core with that sort of
Yes,
volatility.
that probably wouldn't be a core holding.
And what's the third example?
Well, so third example is Jupiter European Opportunities. This fund trades at a much smaller discounts, around 3 percentage points. But again, given that over the last 6 months it has been actually trading at premium, we believe this is quite an attractive entry point. And again, we've got a very experienced fund manager, Alexander Darwell, experienced and pragmatic. You've got tried and tested process that has delivered over long term.
Shimon, thank you very much.
Thanks for having me.
This is Emma Wall for Morningstar. Thank you for watching.